I understand. I know. I consistently mention this is an urgent transmission, but this truly is an urgent transmission. I require you to set aside your coffee because you're on the verge of spewing it out. And I require you to comprehend that what you're observing on the price charts this morning isn't genuine trading. It isn't genuine economics. It's professional wrestling entertainment. It's two individuals in tight elastic shorts striking each other with fake collapsible chairs while the official pretends to be oblivious. Welcome to the WWE domination of the precious metals marketplace. Ladies and gentlemen, Asian guy present. It is Thursday, the 29th of January, 2026. And if you awakened this morning and verified the cost of silver, you likely believed your information feed was malfunctioning. You witnessed a decline so aggressive, so perpendicular, and so statistically unlikely that it appears like a technical error. Silver didn't merely decline, it was murdered. It was hammered down $15 within a span of hours. Gold was taken to the back and executed, plummeting $500 in one trading period. The conventional financial media, the analysts who couldn't execute trades their way out of a paper container, are labeling this a market correction. They are labeling it profit-taking nonsense. Profit-taking occurs when a handful of individuals sell a modest amount to purchase a new vehicle. Profit-taking doesn't obliterate the market by 15% in 20 minutes at 8:30 in the morning New York time. This was an assassination. This was a synchronized algorithmic thermonuclear assault designed to accomplish one thing and one thing exclusively: destroy your mental state. But here's the incriminating evidence. Here's the piece of proof that demonstrates this market is fixed, controlled, and entirely dysfunctional. Typically, when gold plummets, it plummets universally. If individuals are liquidating in New York, they're typically liquidating in London and Tokyo as well. But today, we are observing a malfunction in the matrix that I have never witnessed in 20 years of market activity. We are witnessing a separation. We are witnessing a massive, enormous void opening up between the cost of gold in the United States and the cost of gold in the remainder of the planet. Let's examine the figures, because figures don't deceive. Financial institutions deceive, but figures don't. Right now in New York, the paper cost of gold, the cost on the COMEX, has been crushed down to $5,220. But at this identical moment, if you examine the London spot marketplace, gold is exchanging at $5,480. And if you examine Mumbai, it is exchanging at $5,759. Calculate the mathematics. $5,500 versus $5,200. That is a differential of $300, a $300 variance for the identical asset. In an unrestricted market, this is unachievable. In an unrestricted market, arbitrage automated systems, computing machines designed to locate cents of gain, would capture this within a fraction of a second. They would purchase the inexpensive New York gold and liquidate it in London until the cost is equalized. But today, the automated systems are deactivated. The arbitrage isn't rectifying. The void is positioned there, completely exposed, communicating loudly at us. What does this communicate to us? It communicates to us that this isn't a worldwide liquidation. The planet isn't liquidating gold. India isn't liquidating. China isn't liquidating. Europe isn't liquidating. Exclusively New York is liquidating. This is a concentrated, focused assault on the COMEX paper cost. It's a bare short deluge. The organizations that dominate the US dollar are frightened. They witness the DXY deteriorating. They witness the worldwide confidence in the fiat monetary system disappearing, and they resolve to sacrifice the COMEX to preserve the system. They discharged billions of dollars of paper agreements onto the marketplace during the New York trading period to synthetically demolish the cost, anticipating that if they could create a sufficiently large crimson candlestick, you would become frightened and liquidate your actual metal. They are attempting to manipulate you psychologically. They're attempting to make you accept that the worth of your silver has declined by $15, when in actuality, the remainder of the planet is compensating a surcharge for it. This is the financial equivalent of a Potemkin settlement. It's a counterfeit exterior. The cost on your display, $108 for silver, is a falsehood. It's a cost that exclusively exists in the controlled computing servers of Lower Manhattan. It doesn't exist in the marketplaces of Dubai. It doesn't exist in the jewelry commercial areas of India. And it absolutely doesn't exist in the manufacturing facilities of China. If you liquidate your silver today because of this New York cost, you are succumbing to the most ancient deception in existence. You are liquidating a worldwide asset based on a concentrated manipulation. And to demonstrate it to you, we require to embark on a journey around the planet. We require to examine closely at the narrative of 3 metropolises. We require to contrast the cost in New York, London, and Mumbai in comprehensive detail, because the variation is the indication. So you cannot comprehend the scale of the offense that was executed this morning until you examine the statistics from a worldwide viewpoint. Most capital allocators live in an isolated sphere. They awaken, they verify the application on their mobile device. They witness gold declined $500, and they presume that is reality. They presume that the cost on their display is the universal cost of gold, legitimate from the Arctic Circle to the Antarctic Circle. But today, that presumption isn't merely incorrect. It's hazardous. Today, we're observing the fragmenting of the worldwide cost. We are witnessing an occurrence that financial scholars label market separation, but which I label a narrative of three metropolises. I want to transport you on an exploration of the three most significant financial headquarters in the precious metals universe. And I want you to concentrate very attentively to the figures, because the variance between them isn't a calculation error. It's a chasm. First, let's examine the location of the offense, New York City. This is the residence of the COMEX. This is the paper marketplace. This is where the major financial institutions exchange futures agreements that profess to represent gold and silver. At the termination of the trading period today, after the WWE domination we just analyzed, the cost of gold in New York was positioned at $5,220. The cost of silver was crushed to $108.45. If you are an American capital allocator, this is your circumstance. This is the cost your intermediary will provide you. This is the cost CNBC is broadcasting with a grave expression. Now, let's board an aircraft and travel across the Atlantic to London. London is the center of the physical exchange. The London fix is intended to correspond with New York, but examine the trading displays in the city of London right now. Gold is exchanging at $5,580. Silver is exchanging at $117.38. Pause a moment. $117. In New York, it is $108. That is a variance of $9. That is approximately a 10% variance. How is it achievable that an ounce of silver is valued at $9 additional just because it is positioned on the opposite side of the ocean? It's the identical element. It has the identical atomic designation. It liquefies at the identical temperature. But in London, it demands a substantial surcharge. And if you believe that is insane, let's proceed further toward the Orient. Let's proceed to Mumbai, India. India is the center of the retail gold marketplace. The Indian homemaker is the most intelligent gold exchanger in recorded time. She comprehends worth. And what is the cost in Mumbai today? Gold is exchanging at $5,550. Silver is exchanging at $118.44. Now we have a differential of $10 on silver and $350 on gold between New York and Mumbai. I require you to comprehend how unachievable this is in an operating unrestricted market. We exist in the era of high-speed trading. We have computational programs, supercomputing machines, positioned in New Jersey that are configured to locate cost variations of 1 cent. If gold is 1 cent less expensive in New York than in London, the computing machine purchases New York and liquidates London. It executes this millions of instances per second until the costs are equivalent. It's labeled arbitrage. It's the adhesive that maintains the worldwide financial infrastructure intact. But today, the adhesive has dissolved. The differential is $300 and the automated systems are executing nothing. Why? Why aren't the financial institutions mobilizing resources, purchasing gold in New York for $5,200, transporting it to Mumbai, and liquidating it for $5,500? They could generate billions of dollars without risk in a solitary day. Why aren't they executing it? There's exclusively one clarification. Because the gold in New York isn't authentic. The arbitrage isn't rectifying because you cannot extract the physical metal from the COMEX with sufficient speed to liquidate it in India. The marketplace comprehends that the $5,200 cost is a paper cost. It's a cost for a digital agreement that will presumably be resolved in monetary currency, not gold. The marketplace comprehends that if you attempted to request delivery of 10 tons of gold in New York today to transport to India, the exchange would contact you on the shoulder and communicate, "Apologies, we cannot execute that." So, the arbitrage is dysfunctional. The connection is discontinued. The U.S. marketplace has transformed into an isolated territory. It's an isolated territory of falsehoods floating in an ocean of reality. The remainder of the planet, London, Mumbai, Shanghai, is exchanging the actual physical metal, and the cost is elevated. The U.S. is exchanging a derivative of the metal, and the cost is being controlled lower to preserve the appearance of the monetary system. This separation is the most considerable occurrence of the year. It signifies the U.S. dollar has forfeited its capacity to establish the worldwide cost. For 50 years, New York communicated jump, and the planet inquired how elevated. If New York crushed gold, gold declined in India. But today, New York crushed gold, and India communicated negative. We are not liquidating. In fact, we are purchasing. The controlling entity is no longer manipulating the subordinate entity. The subordinate entity has severed itself. So when you examine that decline on your display, that aggressive crimson line descending, you have to comprehend what you are witnessing. You're not witnessing the worth of your prosperity declining. You're witnessing the trustworthiness of the U.S. cost-establishing mechanism deteriorating. You're witnessing a frantic attempt to create an illustration that the remainder of the planet refuses to acknowledge. The Americans are liquidating paper to each other at $180, congratulating themselves for controlling inflation. Meanwhile, the remainder of the planet is purchasing the actual metal at $118 and ridiculing the Americans. And the greatest ridicule of all is originating from the Far Orient. Because while London and Mumbai are exchanging at a surcharge, there is one location where the cost is even more elevated. There's one location that is regarding silver not merely as a commodity, but as a subject of national protection. We require to discuss China. We require to discuss the cost in Shanghai, which makes the Mumbai cost appear inexpensive. And we require to discuss the reality that you can presently purchase paper in New York for $108 and liquidate the physical in China for $132. This isn't merely a differential. This is the segment of the narrative where the separation ceases being an academic hypothesis and commences being an offense against American prosperity. We have examined London. We have examined Mumbai. But if you genuinely want to witness the forthcoming period, if you want to witness the authentic worth of the metal in a marketplace that is genuinely frantic for it, you have to examine China. Because while the New York financial institution personnel are congratulating each other for crushing the paper cost down to $108, the Chinese marketplace is expressing in distress for physical provision. And the cost they are prepared to compensate demonstrates it. We have just obtained verified information from Wrongton Gold. For those who don't comprehend, Wrongton is not some insignificant establishment in a rear passageway. They are the most substantial precious metals reclaiming and repurchase infrastructure in China. They are the state-authorized organization that establishes the street cost for the typical citizen. If you have a silver bar in Shanghai and you want monetary currency, you proceed to Wrongton. And what is their repurchase cost today? They are proposing 29,590 yuan per kilogram. I require you to retrieve your computing device. At the present exchange proportion, that converts to $132 to $42 per ounce. Let that figure penetrate. $130. In New York, on the COMEX display, the cost is flashing $108. That is a variance of $24.42 per ounce. That is a 22% surcharge. This is not a differential. This is a separate celestial body. If you're liquidating your silver in the United States today at $108, you are effectively contributing $24 of worth to the purchaser without compensation. You are getting defrauded on a historical magnitude. And why is China compensating this? Why is Wrongton Gold proposing such a substantial surcharge to retrieve metal from the populace? Because they have no alternative. The provision infrastructure in the Orient has entirely fractured. We require to revisit the circumstances in Shenzhen, the manufacturing center of the planet. The most recent accounts from the location are getting more severe. It has now been half a month, 15 consecutive days since the major industrial manufacturers have obtained any silver from the Shanghai Gold Exchange. The storage facilities are vacant. The delivery vehicles are stationed. The manufacturing facilities that construct the electronics, the solar panels, and the batteries are positioned inactive, anticipating metal that isn't arriving. Distress is establishing when a manufacturing facility proprietor in Shenzhen comprehends he might fail on an agreement because he has no silver. He doesn't care about the COMEX cost. He doesn't examine New York and communicate, "Oh, the cost has declined, I should postpone." Negative, he examines the regional marketplace and communicates, "I will compensate $130. I will compensate $140. Just retrieve me the metal." This is what is propelling the $132 repurchase cost. It's pure, undiluted physical desperation. China is experiencing a resource cardiac arrest, and the exclusive remedy is to extract every accessible ounce of silver from the remainder of the planet. This creates the ultimate arbitrage. Consider the mechanics of this exchange. If you are a worldwide precious metal financial institution, if you are JP Morgan or HSBC, you have an authorization to exchange in both marketplaces. You can technically purchase a paper agreement in New York for $108. You can request delivery if they permit you, and then you can transport that metal to Shanghai and liquidate it for $132. That is a risk-eliminated gain of $24 on every solitary ounce. On a standard 5,000-ounce agreement, that is a gain of $120,000. It's complementary monetary gain. It's a vacuum extraction device the magnitude of the Pacific Ocean. So why isn't the New York cost ascending to correspond China? Why is the void getting broader instead of narrower? Because the paper controllers in New York are combating the current. They are discharging paper agreements to suppress the U.S. cost, attempting to persuade you that the worth is declining. But all they are executing is making the arbitrage more gainful. All they're executing is incentivizing the extraction. By crushing the cost to $108, they are effectively positioning a 50% discount sale indication on American silver for Chinese purchasers. They are funding the transfer of prosperity from Occidental to Oriental. Every ounce that is liquidated in New York today at this suppressed cost is an ounce that will conclude in a Shanghai storage facility tomorrow, never to reappear. You have to inquire yourself who is on the opposing side of this exchange. If the cost plummeted to $180, somebody had to be liquidating. But more significantly, somebody had to be purchasing. Do you believe the Chinese purchasers are frightened of the decline? Negative. They're ridiculing. They're examining the display and communicating the Americans are insane. They are liquidating us their strategic reserves for a reduction. They are mobilizing the cargo vessels. This collapse is the greatest contribution Beijing could have requested for. It permits them to replenish their vacant storage facilities at a bargain cost, compensated for by the distress of weak-handed Western capital allocators. But here's the complication. Typically, when a marketplace collapses like this, the speculators accumulate on the short position. The investment funds detect vulnerability and they short the marketplace to zero. But today, the information demonstrates something very peculiar. The intelligent capital is not establishing short positions. The investment funds are examining this $130 cost in China, and they are frightened to wager against it. They comprehend that if the vacuum extracts with sufficient force, the New York cost will detonate aggressively to rectify the void. So despite the collapse, the short interest is practically zero. We require to discuss the short entrapment. We require to clarify why the financial institutions are the exclusive ones liquidating and why the intelligent capital is positioned on the periphery with their hands in their pockets. This transports us to the most peculiar statistic of the day. Typically, when you witness a marketplace collapse by 15% in a solitary morning, it activates a consuming madness. The predators detect vulnerability. The investment funds, the computational programs, and the momentum exchangers all accumulate on the short position. They obtain shares through borrowing. They liquidate them, and they attempt to transport the cost down to zero. It's a rush.